Do you know what a credit score is and why it's important? Well, a credit score is more than just a three-digit number. It's like a barometer of your financial health, a numerical summary of your credit worthiness. Imagine you're a bank and someone comes asking for a loan. How do you figure out whether they'll pay you back? You could ask their friends, check their job, or look at how they dress. Or you could use a credit score, a tool that summarizes all of a person's financial history into one tidy number. Lenders, landlords, and even some employers use this score to predict your financial reliability. A high score could mean lower interest rates on loans and credit cards, or the difference between approval and rejection for the same. So, in the world of finance, your credit score plays a pivotal role. Understanding your credit score can open doors to numerous financial opportunities. Ever wondered who's behind these credit scores? Well, let's dive right in. The three main players in the credit score game are Experian, Equifax, and TransUnion. These are the big three credit bureaus that collect and maintain credit information. Experian, the largest of the three, has a database that includes credit information on hundreds of millions of consumers worldwide. Equifax, on the other hand, boasts a global presence in over 24 countries across North America, Central and South America, Europe, and the Asia-Pacific region. Last but not least, TransUnion serves businesses and consumers alike, providing comprehensive data and analytics. These bureaus collect information from various sources like lenders, creditors, and public records to create your credit report. This report is then used to calculate your credit score, which is a numerical representation of your creditworthiness. Remember, these bureaus don't decide whether you get credit or not. They just provide the information. The decision-making power lies with the lenders. These bureaus hold the key to your financial reputation. Are all credit scores graded the same? Let's find out. Credit scores range from 300 to 850. This broad spectrum is typically divided into four categories: poor, fair, good, and excellent. Scores from 300 to 579 are considered poor. Fair scores range from 580 to 669. Moving up the ladder, we have good scores, which range from 670 to 739. Lastly, anything from 740 to 850 is deemed excellent. But let's not forget, each credit bureau might have slightly different scores for the same individual. This is because they may each have access to different credit information. It's also worth noting that not all lenders use the same credit bureau, so your score may differ depending on who's checking. Remember, the higher your score, the better your credit worthiness. Ever wondered what factors contribute to your credit score? Well, it's not just about whether you pay your bills on time. There are 5 main components that make up a credit score, each carrying different weights. First up is payment history, which is the most significant factor and contributes to about 35% of your score. This looks at whether you've paid past credit accounts on time. Later missed payments can negatively impact your score, while consistent on-time payments can boost it. Next is the amount owed, accounting for about 30% of your score. This includes the total amount of money you owe and the amount of available credit you have used. If you're maxing out your credit cards or have high loan balances, it could indicate that you're overextended and may have trouble making payments. The third component is the length of your credit history, contributing 15% to your score. This is determined by how long your credit accounts have been established, including the age of your oldest account, the age of your newest account, and the average age of all your accounts. Generally, a longer credit history will increase your score. The fourth component is the types of credit used, which makes up 10% of your credit score. This includes credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Having a mix of credit types can positively affect your score. The last component, coming in at 10%, is new credit. This looks at how many new accounts you've opened and how many recent inquiries from lenders you have. Opening too many new credit accounts in a short period can signal risk and lower your credit score. Understanding these 5 components gives you a roadmap to navigate your financial behavior. It's not just about paying bills on time, but also managing your debts, maintaining a long and diverse credit history, and being cautious about opening new accounts. Knowing these components can help you steer your credit score in the right direction. So, how can you improve your credit score? Well, there are several strategies you can employ to enhance your credit standing, and they all revolve around responsible financial behavior. Let's dive into some of them. Firstly, paying your bills on time is crucial. Late or missed payments can have a significant negative impact on your credit score. Creditors want to see a history of consistent, prompt payments because it signals that you're likely to repay future debts in a timely manner. So, whether it's your utility bill, your rent, or your credit card bill, make sure you pay them on time, every time. Secondly, reducing your debt is another effective way to improve your credit score. This means chipping away at what you owe little by little, and it's easier said than done. But remember, high debt levels can make creditors view you as a high-risk borrower, which can hurt your credit score. Try to keep your credit card balances low and work on paying off your debts rather than moving them around. Another strategy is to not apply for credit too frequently. Each time you apply for new credit, a hard inquiry is made on your credit report, and this can lower your credit score. So think twice before you sign up for that store credit card just to get a discount on your purchase. Also, keep your old credit accounts open even if you're not using them, as long as they're not costing you in annual fees. A longer credit history can boost your credit score. Finally, monitor your credit report regularly for any errors. Incorrect information on your credit report can drag down your score, so it's important to check and dispute any errors you find. In the end, improving your credit score is not an overnight process. It requires discipline, patience, and a commitment to managing your finances responsibly. The rewards, however, are worth the effort. A higher credit score can open doors to better loan terms, lower interest rates, and more financial opportunities. With discipline and patience, you can improve your credit score. But what if you already have a bad credit score? Well, let's not get disheartened. There are several strategies to fix a bad credit score, and we'll walk you through them right now. First things first, you need to get a copy of your credit report. This report is a comprehensive record of your credit history, and it's the document that lenders use to assess your creditworthiness. You're entitled to one free copy of your credit report every 12 months from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion. Once you have your credit report, it's time to put on your detective hat. You need to comb through the report and look for any errors or discrepancies. These could range from incorrect personal information to wrongly reported late payments. If you find any inaccuracies, dispute them with the credit bureau immediately. Correcting these errors can significantly improve your credit score. Now let's talk about payment reminders. One of the key factors that affect your credit score is your payment history. If you have a habit of forgetting to make payments on time, setting up payment reminders can be a game changer. Most banks offer payment reminders through their online portals. You can choose to receive email or text reminders a few days before your payment is due. Beyond this, consider seeking credit counseling. Credit counseling agencies can provide guidance and create a personalized plan to improve your credit score. They can help you manage your debt, devise a budget, and negotiate with creditors on your behalf. However, do your research and choose a reputable agency to avoid falling into a debt relief scam. Remember, improving a bad credit score is a marathon, not a sprint. It requires patience, discipline, and a solid understanding of your financial situation. But with the right approach and a bit of determination, you'll see your credit score start to climb. Fixing bad credit might seem tough, but with the right approach, it's definitely achievable. And remember, a better credit score opens up a world of possibilities for you, from lower interest rates to better chances at securing loans and credit cards. So start working on your credit score today. Need to contact the credit bureaus? Here's how. You can reach out to the 3 main credit bureaus through their official websites. If you need to contact Experian, you can do so by going to www.experian.com. For Equifax, visit www.equifax.com. And if you need to get in touch with TransUnion, head over to www.transunion.com. These websites are your portals to understanding and managing your credit profile. From these platforms, you can request your credit report, dispute inaccuracies, and learn more about how to improve your credit score. Don't forget, it's your right to access your credit report from each bureau once every 12 months, free of charge. This is not just a privilege, but a tool for better financial management, so don't hesitate to take advantage of it. Remember, regularly checking your credit report is a step towards better financial health. And that brings us to our next topic, understanding your credit report. Once you've received your credit report from the bureaus, it's important to know what you're looking at. Your credit report is a detailed record of your credit history, including open and closed accounts, payment history, credit inquiries, and public records like bankruptcies or tax liens. It's crucial to review this information regularly for accuracy, as it directly impacts your credit score. Here are some things to look for. 1. Personal information. Check your name, address, social security number, and employers. If this information is incorrect, it could be a sign of identity theft. 2. Account details. This includes your credit card accounts, mortgages, car loans, and student loans. Make sure the balances, payment history, and account status are accurate. 3. Inquiries. These are the companies that have checked your credit history. Hard inquiries can impact your score, so ensure these are all companies you've authorized to check your credit. 4. Negative information. This includes late payments, bankruptcies, and foreclosures. These will negatively impact your score, so it's important to ensure they're correct. If you find any discrepancies, you should dispute them immediately with the relevant credit bureau. Understanding your credit report is the first step in taking control of your financial future, so don't gloss over any details. Next up, we'll talk about some practical ways to improve and maintain a good credit score.